If you look at the macro picture and look at a 5 year or 3 year chart of gold, you'll see, and silver compared, you'll see that gold has really outperformed silver and in terms of its movement, which is normal. I mean, normally we see gold go first and then silver go further in terms of a percentage gain. But when you look at silver right now at below half of its 1980 peak and gold with within 10% of its all-time high,
Right.
uh, there's a little bit of a disconnection right there. And
Mm,
when you think about the fact that silver is a very, very important metal. We understand that in digital and green applications, it's experienced a renaissance in monetary applications. It's dominated the amount of sales this industry has done for the last 3 years. It's probably 90% of all the business we've done, if not more. We've
really?
had record year after record year after record year. We're going to do close to $1 billion in sales this year.
That's
And
amazing.
most of it has been in silver, and yet silver has underperformed. And when you think about it, in a world that's kind of off the hook, in a
Yeah.
world where gold is doing very well, you would think silver would be following part and parcel. Let's say I own 5,000 ounces of gold in my warehouse, right?
Okay.
And we probably own more than that, but let's just say it's 5,000.
All
And
right.
um, it's in my warehouse and the price of gold falls by $100 an ounce. So you just saw it go up 140. And if you look back before that, it fell almost 200. And so let's say it falls $200 on those 5,000 ounces. I'm down $1 million.
Yeah, that's right.
And well, you go out of business if you speculate that way.
Mm-hmm.
And so, what we do is we take the other side of it on Comex. We do what's called a covered short. Covered meaning we have the metal right there. We're shorting on the other side to remain market neutral. So
Okay.
as my physical goes down by $200 an ounce, rendering my physical in-house gold down $1 million from what I paid for it, it goes up commensurate $1 million on what I sold short on Comex. If you are a commercial bank, a central bank with unlimited resources, knowing the playbook, and in some cases, arguably been given a green light from the powers that be in order to do this, in order to support the bond market or in order to support the military industrial, uh,
Mm-hmm.
um, you know, um, complex, or
Yep.
then if you have that kind of wealth, you can create a perception of reality. That is exactly how they suppress it. They suppress it with rhetoric, and they suppress it with price and leverage, and they do it in a counterintuitive fashion, knowing that the majority of the commodity traders on the planet and advisory services employ technical analysis. So if you violate moving averages, if you like the 200 and the 50-day,
Yep.
if you blow through all of these technical resistance levels, a lot of Wall Street, a lot of the commodity complex is controlled by non-emotional algorithmic black box programs, where if it passes this line in the sand, instantly it sells,
Okay.
and selling begets selling begets selling. So they do it knowing where everyone is positioned, because the commercial banks typically are selling the options. They have deeper pockets,
Mm-hmm.
and they have the ability to control this with a tremendous amount of leverage. Big deliveries are coming off of Comex, coming off the LBMA. The metal for them to be able to do this, it's disappearing. And so I think it's an
Yeah.
issue that I really do believe that it is an issue that we will see ultimately come to an end. But what has it enabled? It has enabled a lot of these very large institutions to de-dollarize, to accumulate copious amounts of gold and silver, do it in a very methodical fashion,
Yeah.
and using the suppression of the Western paper market against us. They're using our own leverage against us by standing for delivery, and I think this will continue until there are no more cheap ounces of gold or silver to be given away to these buyers, and then all of a sudden, the Comex market is exposed for what it is. What is different about this market, and why I think it will end at some point, is that
Okay.
normally when you short the market, you short something that's falling in price. Think AMC and GameStop. They were
Okay.
getting crushed and everyone jumped on and kept shorting it, pushing it down lower and lower and lower and lower, right?
Right.
You're selling into a falling market. It
Yeah.
is very, very, very dangerous to short the managed money. The commercial banks will go long, and it's typically a zero sum game where
Okay.
the commercials go long and the hedge funds go short and vice versa. So if the commercial banks go long on the COMEX and the price starts to go up, and when you think of commercials, JP, Citi, Goldman, they got all of the money and they know the playbook. They have very, very deep pockets. And
Yeah.
some people would say JP Morgan and Goldman Sachs are extensions of the Federal Reserve and the government, respectively.
Yeah.
Maybe they are. It's that revolving door. But anyways, so they go long. The price starts to go up. They push it through moving averages and resistance levels, triggers the buying that the algorithms say it's now in a bull zone. Go buy it. So the hedge funds, they go long. Now, when they go long, that means that the commercial banks are going short, right? They take opposite sides. So the commercial banks start to push the price up. The hedge funds jump in, the commercial banks take the other side. The price starts to rise as the hedge funds put more and more and more and more money into it. And as the price is going up, then what the commercial banks do is they start to short on their own. They short, they overwhelm, and bang, the hedge funds capitulate and sell. The commercial banks pickpocket the premiums on the options that they sold to the hedge funds. The hedge funds ride the price up, but when the commercial banks overwhelm the hedge funds by selling into a rising market, it's ending. We're seeing
Okay.
massive deliveries off the COMEX and the LBMA and the London Metals Association. And so one of these days, and I think it's growing to one of these final stage moments that we have here, the commercial banks will go long and they will not short the rising market. They'll go long because they are the most well-funded and well-informed traders on the globe, and they'll let it run because they've done the same thing forever. And what that means is the hedge funds will be short and the
Yeah.
price will go to the moon. And if there's not enough gold and silver back there to cover those short positions, when the hedge funds, after they start to realize some losses, they'll be cover, but there are no bars to cover. It will put hedge funds out of business like
Wow.
that. And that's the ultimate end game. And when
Okay.
there's no incentive to buy gold and silver, it's an easy game to play. But when the whole world realizes that, look, the accumulation of treasury bonds as a form of savings in a historical context, it's very brief.
Yeah.
It's a very small period of time where the world thought buying government debt was a form of savings. And I think when you look at the last 3 years in the treasury market being the worst bear market in the history of bond markets, well, there's a realization that maybe gold is a better choice.